The first warning did not come from a dramatic confession, a hidden email, or a late-night phone call from someone with a guilty conscience. It came from a spreadsheet. My name is Olivia Fontaine, and that was how I learned that my business partner, Marissa Vale, had been fabricating our company's financial reports while preparing to sell a large part of her own equity stake before the truth came out. One clean, ordinary due diligence spreadsheet from a potential investor, with one cell highlighted in yellow and a short note beside it that made my stomach drop before I even understood the full meaning. The note said that our reported quarterly revenue did not match the actual deposits moving through our bank accounts. At first, I thought it had to be a timing issue, a transfer posted late, a client payment booked in 1 month and deposited in the next. Something boring and fixable, but the discrepancy was not small, and it was not isolated. What we had been showing as a steadily growing, healthy company on paper looked, once the bank records were compared directly, like a company that had been quietly losing ground for almost a year. I had trusted Marissa with the day-to-day financial reporting because she had earned that trust over years, or at least I believed she had. We started the company together 5 years earlier, 2 women with different strengths and one very clear plan. I handled client relationships, operations, hiring, and the painful work of keeping projects moving when everything wanted to stall. Marissa handled finance, reporting, investor updates, payroll oversight, and the clean executive summaries that made our messy little company look orderly from the outside. We were not a giant corporation. We were a growing business services firm based in Columbus, Ohio, with 23 employees, a rented office with too many glass walls, and a reputation we had built one client renewal at a time. In the early years, Marissa and I used to sit on the floor after midnight with takeout containers between us, celebrating every signed contract like we had won a championship. She was sharp, calm under pressure, and almost annoyingly good at making numbers tell a story. I was grateful for that because I did not want to live inside spreadsheets every day. I reviewed her quarterly summaries, asked questions when something looked unusual, and made decisions based on the financial picture she presented. What I did not do, and what I will regret for the rest of my career, was independently compare those polished reports against the actual bank deposits. I assumed the reports were anchored in reality because the person preparing them was my partner. That assumption nearly destroyed everything we built. The investor who raised the concern was part of a small outside group considering a minority investment in our company. We had been exploring a capital raise to expand into 2 new markets, and their team requested the usual materials: profit and loss statements, bank statements, accounts receivable aging, client contracts, payroll summaries, and forecasts. Nothing about the request felt threatening. In fact, Marissa had encouraged it. She told me repeatedly that outside capital would let us move faster, hire a stronger sales director, and stop turning down large clients because we lacked capacity. I agreed with the strategy. Our reports showed enough growth to justify expansion, and although cash sometimes felt tighter than the summaries suggested, Marissa always had an explanation: delayed receivables, seasonal hiring, one-time software costs, tax planning. She said these things with such ease that I accepted them as the normal discomfort of a growing company. Then the investor's analyst, a woman named Dana, asked for a call. Her tone was careful, the way people sound when they know they are about to ruin your afternoon. She said, "Olivia, before we go any further, can you help us understand the difference between the reported Q2 revenue and the deposits reflected in the operating accounts?" I remember looking across the conference table at Marissa, who was sitting beside me with her laptop open. She did not flinch, but her hand moved to the trackpad and stayed there. I said, "There may be some timing differences. We can walk you through it." Dana replied, "We expected timing differences. This is larger than that." The words landed in the room and changed the temperature. After the call, I asked Marissa what Dana was seeing. She gave me a quick answer, too quick. She said the investor probably did not understand how we booked revenue on signed contracts, and that some client deposits had cleared after quarter end. I asked her to prepare a reconciliation by the next morning. She nodded, closed her laptop, and said, "Of course." This is exactly why I hate giving raw bank records to people who do not understand our business. That sounded plausible, maybe even reasonable, but it bothered me that she sounded irritated instead of concerned. If it was only a misunderstanding, we could fix it with documentation. If it was bigger, we needed to know immediately. That night, I sat at my kitchen island with my own laptop open, trying to pull together what I could access without her. I had administrator access to our banking portal, but I rarely used it except to approve large transfers or verify payroll funding. The numbers I saw did not align cleanly with the summaries I had been receiving. I told myself not to jump to conclusions. Accounting mistakes happen. Revenue recognition can be complicated. A growing business can have messy books without anyone being dishonest. Still, a knot formed in my chest because the gap was not a rounding error. The next morning, Marissa sent me a reconciliation that was more explanation than proof. It described categories, timing, and accrual treatment, but it did not tie each reported revenue figure to actual money received. I asked for the underlying schedule. She said her controller was cleaning it up. We did not have a controller. We had a bookkeeper named Leah who worked 3 days a week and handled routine payables under Marissa's direction. When I said that, Marissa corrected herself and said she meant our outside tax preparer. That was the first moment I felt something cold and specific move through me. Not proof, not yet, but the recognition that my partner was improvising. I did not accuse her. I did not raise my voice. I simply told her that because an investor had flagged the issue, we needed an independent review. She looked offended. Independent review of what? She asked. Of the revenue reporting, I said. Bank records, quarterly reports, receivables, everything for the last year. Her face tightened. That is excessive, I said. Maybe. But if it is excessive, the review will prove that quickly. She stared at me for a few seconds, then said, "Do what you need to do." That sentence sounded cooperative, but it was not. It sounded like a door closing. I called an attorney that afternoon, Priscilla Nakamura, who had helped us with contract disputes in the past. I chose her because she was direct, careful, and not easily impressed by panic. I explained exactly what had happened, including the investor's concern, Marissa's explanations, and my own uncertainty. Priscilla listened without interrupting. When I finished, she said, "Do not accuse her yet. Preserve records. Do not let anyone alter the reporting files. And you need a forensic accountant, not a regular bookkeeper." She referred me to Cornelia HB, a forensic accountant who had handled internal fraud investigations for private companies and investor disputes. Cornelia was calm in a way that made me both grateful and terrified. On our first call, she asked for bank statements, financial reports, investor materials, general ledger exports, accounts receivable lists, client invoices, and any drafts Marissa had shared. She also asked who controlled access. When I told her Marissa did, Cornelia said, "Then your first priority is getting a complete copy of everything before anyone knows exactly what we are comparing." Priscilla sent a formal preservation notice to Marissa and to our outside vendors. I authorized read-only access for Cornelia to the bank accounts and accounting software. I also asked Leah, our bookkeeper, to export the ledger and invoice history. Leah looked confused and scared when I called her into my office. She said, "Did I do something wrong?" I told her no, and I meant it. I asked whether Marissa had ever instructed her to change revenue entries after month end. Leah hesitated. That hesitation told me more than her first words did. Eventually she said, "Sometimes Marissa would send me adjusting entries and say they were accrual corrections. I did not question them because she approved all reporting. I asked if she still had those emails. Leah said yes. I asked her to forward them to Priscilla. After she left, I sat alone for a minute with the door closed, staring at the wall and trying not to let fear turn into anger too early. There is a particular kind of dread that comes from realizing the problem might not be outside your company. It might be inside the office next to yours, wearing the same tired smile you have trusted for years. Cornelia began with 1/4 and expanded backward. Her first update came 4 days later. She did not use dramatic language. She said, "The reported revenue is not supported by deposits for the period. Some of the difference is timing, but not most of it." She identified invoices that had been counted as collected revenue even though the clients had not paid. She found projected renewals booked as if they were signed contracts. She found credit memos delayed so cancellations would not hit the quarter where they belonged. She found entries labeled as deferred deposits that had no matching bank activity at all. When I asked whether this could be sloppy accounting, Cornelia said, "One adjustment can be sloppy. A pattern of adjustments moving in one direction, quarter after quarter, is not usually accidental." The words made me feel physically ill. I had been presenting those numbers to staff, lenders, vendors, and potential investors. I had used them to approve hiring decisions. I had reassured employees that our growth was stable. I had looked people in the eye and repeated figures I believed were true. Cornelia's review widened to the entire preceding year, and the picture became worse with every file she touched. Our actual revenue had been declining steadily for 3 quarters, not catastrophically at first, but enough that we should have tightened expenses, renegotiated vendor terms, paused hiring, and changed our expansion plans. Instead, Marissa's reports showed consistent growth, 6%, then 9%, then 11%. The gap between reported revenue and actual deposits grew larger at the exact time Marissa began quietly negotiating to sell part of her equity stake. I did not know about those negotiations until Priscilla found references in emails with the outside investment group. Marissa had presented herself as willing to sell a portion of her own shares to make room for new investors and to diversify her personal finances. On the surface, that was not illegal. Founders sell secondary shares sometimes, but the investors had priced her stake based on financial statements she prepared, and those statements were inflated. The timeline was brutal. The first significant inflation happened during a difficult quarter when we lost 2 mid-sized clients and a large renewal was delayed. The second quarter showed more aggressive adjustments. By the third, the numbers no longer resembled the bank activity. 6 weeks before Dana flagged the discrepancy, Marissa had sold 30% of her equity stake to the outside group. The sale proceeds went to her personally. She had not sold company shares to raise capital for operations. She had cashed out a large piece of her ownership based on a financial picture she knew was false. When Priscilla explained the significance, she did it carefully. This is not only an internal partnership dispute, she said. If she knowingly gave investors fabricated financials so they would buy her stake at an inflated value, that creates serious securities fraud exposure. The company may also have claims against her for breach of fiduciary duty and damages caused by the false reporting. I asked what would happen to the company. Priscilla did not soften it. That depends on how quickly you stabilize the truth, notify the right parties, and separate the company from her conduct. It is strange how betrayal can arrive in layers. First, I felt betrayed as a partner. Then as a friend. Then as an employer who had relied on false information to make decisions affecting other people's jobs. Then as a woman who had worked so hard to be taken seriously in rooms where people already assumed female founders were either too cautious or too emotional, only to discover that the biggest threat to my credibility had been sitting beside me in those same rooms. I knew I had to confront Marissa eventually, but Priscilla told me not to do it until Cornelia's reconciliation was complete enough to withstand denial. For 2 weeks I kept working with Marissa while the investigation continued. Those 2 weeks were some of the longest of my life. Every meeting felt unreal. Marissa sat across from me discussing client onboarding, cash flow, and investor questions as if nothing had shifted. She asked whether Dana had sent additional diligence requests. She suggested we delay giving the investor more bank records until our explanation was cleaner. She used that word several times. Cleaner. I started hearing it differently. One afternoon, we had a tense meeting in the small conference room where we used to celebrate good news. I asked her again for the detailed support behind Q3 revenue. She opened a folder on her laptop and walked me through a summary page. I said, "This does not show deposits." She said, "Because deposits are not the only measure of revenue." I said, "They are one measure we cannot ignore." She looked at me and said, "You are letting an investor spook you." I answered, "I am letting bank records inform me." Her jaw tightened. She said some clients paid in irregular cycles, that our accounting method had always included accruals, that I was not appreciating how sophisticated reporting worked. That last part almost made me laugh, because it was exactly the kind of sentence people use when they hope insecurity will silence a woman. I had spent years dealing with people who assumed I did not understand finance because I preferred plain English to jargon. I said, "Then give me the schedules that tie the accruals to signed contracts and expected payments." She said she would. She did not. That evening, Leah forwarded a batch of emails to Priscilla and Cornelia. In several of them, Marissa instructed her to record expected renewals as booked revenue before the clients had signed. In another, she told Leah not to apply a cancellation credit until the next quarter because we need to keep the investor package consistent. In one message, Leah asked whether an adjustment had support. Marissa replied, "I will handle support if anyone asks." Reading that line felt like watching a curtain rip. Cornelia used those emails to trace the adjustments against the ledger and bank records. The pattern was deliberate. Reported revenue had been lifted by moving projected or unsupported amounts into current periods, delaying negative adjustments, and creating categories that obscured the lack of matching deposits. It was not sophisticated enough to fool a forensic accountant, but it was polished enough to fool a busy partner who trusted the person producing the reports and outside investors who had not yet dug into the bank records. I keep returning to that point because it matters. Fraud does not always look like a secret vault or a forged signature. Sometimes it looks like an attractive quarterly deck, a confident voice, and a partner saying, "I have it handled." Cornelia's final reconciliation was nearly 80 pages, with schedules attached behind it. She compared each reported quarter to actual bank deposits, invoices, client contracts, credit memos, and ledger entries. She showed the revenue decline that should have been visible. She showed the inflation that made the company appear to be growing. She mapped the timing against Marissa's equity sale negotiations. She identified the exact entries that lacked support or were improperly moved. She also included Leah's emails and notes about access controls, showing that Marissa had authority over the reports and personally approved the adjustments. When Priscilla and I reviewed the report with Cornelia, I felt a strange combination of relief and devastation. Relief because I was not imagining it. Devastation because the truth was worse than I had hoped. I asked Cornelia whether there was any reasonable interpretation under which Marissa had misunderstood the numbers. Cornelia paused before answering, not because she was unsure, but because she wanted to be precise. In my opinion, she said, the sustained direction of the adjustments, the absence of support, the concealment of bank discrepancies, and the timing of the equity sale are inconsistent with innocent error. That was the sentence I carried into the confrontation. Priscilla arranged for the meeting to take place in our office with her present. She advised me to keep it factual, avoid personal accusations beyond what the evidence showed, and document everything. Marissa came in wearing a cream blazer I had seen her wear to investor meetings. She looked composed until she saw Priscilla and Cornelia already seated. Then her expression changed. She said, "What is this?" I said, "We have completed the reconciliation." She glanced at Cornelia's binder on the table. "You brought an accountant to ambush me?" I said. "We brought the records." Priscilla began by laying out the findings: unsupported revenue entries, delayed credit memos, projected renewals booked as current revenue, discrepancies between reported figures and deposits, and the timing of the equity sale. Marissa denied the interpretation at first. She said the business had complex billing cycles. She said everyone knew we used accrual accounting. She said I had approved the summaries. That part stung because it was partly true. I had approved summaries based on her representations. But approval based on false information is not consent to fraud. Cornelia calmly opened schedule after schedule. She showed one quarter where reported revenue exceeded deposits and supported receivables by hundreds of thousands of dollars. She showed another where a canceled client remained in projected revenue after termination. She showed the entries Marissa had instructed Leah to make. Marissa's face lost color. When Priscilla placed the emails beside the equity sale timeline, Marissa stopped arguing about accounting methods. For a long moment, nobody spoke. Then I asked the question I had been holding back for weeks. Did you know the company was declining when you sold your shares? Marissa looked down at the table. She did not answer immediately. I said, "Did you know?" Her voice was quieter when she finally spoke. "I knew we were having a bad stretch." I said, "That is not what I asked." She closed her eyes for a second and said, "Yes, I knew the reports were optimistic." Priscilla said, "Optimistic is not the word for unsupported entries." Marissa's composure cracked then, but not in the way I expected. She did not apologize at first. She explained. She said it started during the first bad quarter when we lost the 2 clients. She said she believed the revenue would recover quickly, and that showing the decline would spook lenders, staff, and investors. She said she made temporary adjustments to smooth the quarter. Then the next quarter came, and performance did not improve enough. By then, she said, reversing the adjustments would make the decline look even sharper, so she kept going. She said the investors approached her about buying part of her stake, and that she realized the inflated numbers made her equity far more valuable than it would have been if the real financial trend were visible. I asked, "So you sold before anyone could see the truth?" She started crying then, but I could not tell whether the tears were remorse or fear. She said, "I felt trapped." I said, "You were not trapped. You chose to trap everyone else." That was the only personal sentence I allowed myself in the meeting, and I do not regret it. She had trapped the investors who relied on false numbers. She had trapped me into making operational decisions with bad information. She had trapped our employees inside a company whose actual condition was worse than leadership had represented. She had trapped the business itself in a false version of success until the cost of correction became much higher. After the meeting, Priscilla moved quickly. Marissa was removed from financial authority immediately under the terms of our operating agreement, pending formal action. Access to accounting software, banking portals, investor materials, and reporting systems was restricted. We notified our board advisor and the affected investors through counsel. Priscilla filed civil claims on behalf of the company for breach of fiduciary duty, fraud, and damages connected to the false reporting. She also pursued claims related to Marissa's equity sale, arguing that the sale was based on fabricated financial statements she had personally prepared and presented. The outside investors were furious, and they had every right to be. One of them, a man named Elliot, called me after the initial legal notice and said, "How could this happen without you knowing?" It was a fair question, and it hurt because there was no answer that made me look good. I told him the truth. I trusted the internal reports, and I should have verified them against the bank records sooner. He was quiet for a moment, then said, "At least you are not pretending otherwise." That became my approach with everyone. No pretending. I met with our senior staff and told them that previously reported financials had been found inaccurate, that an independent forensic review had identified deliberate misconduct by Marissa, and that we were taking legal action. I did not share every detail because some matters were confidential, but I refused to insult them with vague corporate language. People cried. People got angry. People asked if payroll was safe. That was the question that cut deepest. Payroll was safe for the immediate period, but the company had to make hard decisions quickly. Because the real financial picture showed declining revenue, we froze hiring, canceled the expansion plan, renegotiated vendor contracts, and reduced discretionary spending. I took no distribution that year. I also cut my salary before asking anyone else to absorb pain. We avoided layoffs at first by moving people onto revenue-generating client work and pausing projects that had been approved under the false growth assumptions. Eventually, we did eliminate 3 roles connected to expansion efforts we should never have started. I personally met with each person affected, provided severance, references, and introductions where I could. Those conversations were among the hardest consequences of Marissa's choices, because the people losing their jobs had done nothing wrong. Legal accountability moved more slowly than emotional anger wanted it to. Priscilla warned me from the beginning that even obvious misconduct still had to be proven in the right format, through documents, testimony, and process. Cornelia's forensic report became the foundation. The investors demanded rescission of Marissa's equity sale or repayment of the proceeds. The company demanded damages and indemnification for costs caused by the false reporting. Marissa hired her own attorney and tried, at first, to frame the issue as aggressive accounting during a volatile growth period. That argument did not survive the emails, the unsupported entries, or the timing. During mediation, her attorney suggested that I shared responsibility because I had reviewed quarterly summaries. Priscilla responded by walking through the difference between relying on a partner's certified internal reports and knowingly creating false entries. She also pointed to Marissa's personal profit from the equity sale. The mediator, a retired judge, asked Marissa directly whether she disputed sending the emails instructing unsupported adjustments. She did not. After months of pressure, Marissa agreed to return the proceeds from the 30% equity sale, with the funds placed toward resolving the investor claims and stabilizing the company. She also surrendered her remaining management rights and exited the company entirely under a settlement that preserved our ability to cooperate with any formal fraud investigation. Because the conduct involved investor materials and the sale of equity based on false financials, it did not end as a private disagreement. A formal fraud investigation followed. I will be careful about wording because investigations have their own rules, but I can say this. Once outside investors relied on fabricated numbers in an equity transaction, the matter became much bigger than hurt feelings between former partners. Cornelia told me something after her review closed that stayed with me. She said, "When partners fabricate reports to inflate their own equity value before a personal sale, it is especially damaging because the lie travels in 2 directions. It harms the company and the remaining stakeholders internally, and it harms the outside investors who use those numbers to decide what the ownership is worth." That was exactly what happened. Marissa's false reports did not merely hide a decline. They distorted value. They delayed corrective action. They transferred risk from her to everyone else while she took cash off the table. And because she had been the financial face of the company, her misconduct threatened the credibility of every honest person still working there. Rebuilding took longer than I wanted and more discipline than I expected. The first step was replacing trust with controls. That sounds cold, but in business, controls are not the enemy of trust. They are what keep trust from becoming a blindfold. I hired an outside accounting firm to manage monthly closes and required quarterly independent reviews. Bank reconciliations were no longer summarized in a deck without supporting schedules. Revenue recognition policies were documented in plain language and reviewed with counsel. Any adjustment above a modest threshold required dual approval and source documentation. Investor updates included cash metrics, not just booked revenue. I created a finance committee with one outside advisor who had authority to ask uncomfortable questions. I also made sure no single person, including me, could control reporting from entry to presentation. At first, the new process felt expensive and heavy. Then I remembered what the old process had cost us. The cultural repair was harder. Employees do not automatically regain confidence because you install better software or hire auditors. They watch what leadership does when nobody is clapping. So I made the financial recovery visible without oversharing confidential information. Every month I held a staff meeting where I explained where we stood in practical terms: cash runway, client retention, sales pipeline, and operating priorities. I stopped using vague growth language. If revenue was flat, I said it was flat. If a client delayed payment, I explained the impact. If we won new work, I celebrated it without pretending one contract solved everything. Some people left because they no longer felt secure. I understood. Others stayed and became the reason we survived. Leah stayed too. She was ashamed that she had entered adjustments without pushing harder, but I told her the responsibility belonged to the person who abused authority, not the employee who had been trained to follow it. We changed her role, gave her direct access to the outside accounting team, and created a protected path for raising concerns. Over time, she became one of the strongest advocates for clean reporting in the company. The investors were slower to come around. I do not blame them. They had bought Marissa's shares at a price supported by false statements. Returning the proceeds helped, but money alone did not restore confidence. I sent them Cornelia's corrected financial package, the control changes, and monthly recovery updates. I also invited them to meet with the outside accounting firm directly. One investor declined and exited as soon as the legal structure allowed. Another stayed but remained cautious. Dana, the analyst who first flagged the discrepancy, eventually told me she appreciated that we did not bury her concern or punish the messenger. I told her she had probably saved the company. She said, "Your bank records saved the company." I just asked why they did not match. That sentence became almost a personal rule for me. Ask why the records do not match. Not because every mismatch is fraud, but because reality deserves priority over presentation. About a year after the discovery, we were smaller than the version of the company Marissa had been selling, but we were real. Revenue had stabilized. Margins were improving. We had rebuilt client trust by focusing on delivery instead of expansion headlines. We had paid down emergency obligations and settled the most urgent investor issues. The office felt different, less flashy, less breathless, more serious. I missed the innocence of the early days sometimes, but I did not miss the illusion. One afternoon, I found an old photo of Marissa and me from our first year, sitting on the floor with laptops and takeout, exhausted and proud. I expected to feel only anger. Instead, I felt grief, which annoyed me at first. But grief made sense. I had lost a partner, a friend, and a version of the company I thought we were building. Still, grief did not erase accountability. Marissa had choices at every stage. She could have told me the first bad quarter was worse than expected. She could have recommended cuts. She could have delayed her equity sale. She could have disclosed the real numbers to the investors. She could have stopped after the first false adjustment. Instead, she chose concealment, then profit, then denial. People sometimes ask whether I should have seen it sooner. The honest answer is yes. Not because I should have assumed betrayal, but because leadership requires verification even when trust feels earned. I should have reviewed bank reconciliations personally. I should have made sure our reporting process did not depend on one person's unchecked authority. I should have noticed that cash felt tighter than the growth story suggested. Those failures are mine, and I do not hide from them. But they do not make Marissa's actions less deliberate. There is an important difference between missing a control weakness and exploiting one. I missed it. She exploited it. The lesson I carried forward was not that you should never trust anyone in business. That would make leadership impossible and life miserable. The lesson was that trust without transparency is not a virtue. It is a risk waiting for pressure. Good partners welcome verification because it protects everyone, including them. Clean books should survive questions. Real revenue should tie back to records. A company that cannot explain the difference between its reports and its deposits is not ready to ask anyone for money. If Dana had not asked one direct question during due diligence, Marissa might have sold even more of her stake. We might have expanded into markets we could not afford. We might have kept hiring into a decline. The eventual collapse would have been uglier, and more people would have paid for a lie they did not tell. Instead, the truth arrived early enough to hurt, but not too late to survive. That is the strange mercy in this story. The discrepancy that humiliated me also saved me. The yellow highlighted cell that made me feel exposed became the starting point for rebuilding the company on numbers that could stand up to daylight. I still run the business, but I run it differently now. Every quarter, when the financial package comes in, I read the summary last. First, I look at bank activity, receivables, cash position, client changes, and adjustments. Then I read the story the numbers are trying to tell. If the story and the records disagree, the records win, always. I wish I had learned that lesson in a less expensive way, but some lessons arrive with invoices, legal fees, broken friendships, and long meetings you never forget. If you had been in my position, would you have confronted your partner right away, or waited for the forensic report before making a move? And if a trusted person in your business controlled the numbers, how often would you check the records yourself? Share what you would have done, because I know many people only think about these safeguards after something goes wrong. Thank you for listening to my story. If it made you think about trust, money, and the quiet danger of unchecked authority, subscribe for more true-to-life stories about betrayal, accountability, and rebuilding after someone close turns the truth into a weapon. Take care, and I hope your trust is always matched by transparency.